Hello everyone, Joe Mass here. Hey, today I want to take you through our focused tactical allocation portfolios, aka our sailboats. I want to show you how we build them, how we think about them. They're doing very well this year. They're a great risk-off portfolio to help you manage risk, yet still get some upside in the market. Thought I would take the opportunity to show you how we build them. The sailboats, we call them focused tactical allocation for a couple reasons. One, we focus in that we don't follow modern portfolio theory and buy just a bunch of everything. What we're doing is we're identifying and selecting a few of the right investments. So that's very focused. They're also tactical because we trade these once a month and we're always trying to be at the right place at the right time. And then third, their allocation because they do maintain a strategic overlay of fixed income and equity. The sailboats don't live on an efficient frontier, right? Most of the time under modern portfolio theory, you'll see that return axis on the Y axis, the vertical axis. You'll see risk on the X axis or the horizontal axis there. And you'll notice that the sailboats, they just go wherever the wind goes. If you think about how a sailboat moves through the water, it doesn't go in a straight line. It tacks, it goes left, it goes right. We get from point A to point B, but not in a straight line. Okay, and so again, if the market goes up, we put the sails up. If the market goes down, we put the sails down. So as the market ebbs and flows, these sailboats navigate the pitfalls of the market. Okay, they don't follow asset allocation principles or a mean variance optimization process. They are tactical rotation portfolios. When we're building a tactical portfolio, it's kind of like steering the boat, right? We're gonna use lots of pieces of information to build and run the boat. So we're gonna use rules-based technical analysis. We're gonna use multi-factor models and regression. We're gonna use multiple ranking methodologies for final security selection. We're gonna use charts, right? Your price and volume and all the good technical analysis that's out there. So we're not just doing one method or one strategy. We're looking at the preponderance of the evidence using all the math and science and then making the best active decision that we can. So these aren't black box portfolios. These are portfolios that are actively managed using institutional processes. And then on top of the various studies and indicators that we use to run the boats, we also have a strategic overlay to keep us on course, okay? And so we maintain a conservative to aggressive portfolio so that each investor can find the risk temperament that's right for them. So the nuts and bolts of the portfolio follows a four-step process. So the first step is we establish a universe, and we're going to go through each one of those over the next couple slides. So we're looking at 200 plus global asset classes. The second step is to monitor the market to determine if we're in a bullish mood or if the market's in a bearish mood. Okay. The third step is then to take that information, knowing from step two, knowing that we're bullish or bearish, and then we have to build the portfolio. And then in step four, we are going to repeat steps 2 and 3. Okay, so the first step is we start off with a large radar screen. Okay, so we have, again, 200 plus global asset classes that we're looking at. We're not a manager that's stuck in a box where we're only looking at style boxes, value and growth and blend. And we're not just looking at small or mid or large companies. We have a very large radar screen because we don't care where return comes from. We just want to look at the global universe and then go find return. We look at market capitalization, small, mid, and large. We look at market equal weight, small, mid, and large. We're going to look at style, right? We're going to look at the value, the growth, and the blend. We're going to look at global sectors, and we're going to look at countries. So at one point, we might be in large cap European banks, we might be in small cap Japanese utilities, we might be in the peso, we might be in the S&P 500, okay? We don't really care where the return comes from. We just want to look at this global footprint, this global radar screen, and then select the markets that are working. The next step is we have to monitor the market. How we do that is we're looking at a lot of data. We're looking at hundreds of indicators, but these indicators are usually bull or bear. They're binary, right? They're zeros and ones. As illustrated here, they're either up or down. And you can't really tell from this graphic here what's working, right? They're just lines up or down. So we have to do our first layer of statistical smoothing. We have to take that raw weighted data and we have to smooth it. Now the line is starting to look a little more like something we can make a decision from. But it's not done yet. We take another layer of smoothing and then we can determine whether we're bull or bear. Okay, so of course if the bar is up, thumbs up, we're bullish. thumbs down, we're bearish. If the line is flat, we don't know. So we take this information, and that's how we build our sailboat, right? We know when to put the sails up. So if we're bullish, all the sails are going to go up. If we're bearish, the sails are going to go down, right? We're going to go into a defensive mode, and we're going to stay safe in the harbor, okay? So that's how we know whether to put the sails up or down, is by understanding if we're bullish on the market, and not only bullish on the short end of the market, but on the midterm and the long-term part of the market. So if you think about how a boat sails, it has to look far into the horizon. And so we need to know if it's stormy way out on the horizon, but calm currently, and halfway between the horizon and where the boat's at, it might be starting to get turbulent. We're going to make a decision on the market on a short, mid, and long-term basis. Okay, so we're going to make a view of being bullish short, mid, and long-term. So when we bring it all together again, we can see here that first step is to look at that raw data. We do some smoothing, we do another layer of smoothing that results in a bull or bear, and that bull or bear call then lets us know whether we should put the sails up or down. Step 3. Now we have to build the portfolio. Each portfolio of a sailboat has an upper deck, and that's where the sails go. It makes the boat go fast. And then the bottom of the boat is the fixed income, right? The keel of the boat. And this is where we provide the safety in the portfolio. If we're bullish on the short end of the market, we might have one sail up, and if we're bullish on all parts of the market, we might have all of our sails up. The first sail that we look at is what we call long only. And so if we're bullish on the long-term part of the market, we're going to be in the top 1 to 3, maybe even 5 equities of our equity universe. If we're bearish on the long end of the market, we're going to put that sail down and go to cash. The next strategy, okay, is a broad sector global rotation. This sail is always up. It's not driven by a signal. However, if the global equity markets are melting down, we will switch that to fixed income or cash. The third sail we're going to look at is what we call our long equity strategy. So if we're bullish on the short end of the market, we're going to be in the top 3 to 5 equities out of that universe. If we're bearish on the short end of the market, we're going to short the market, right? We're going to turn the sail the other way. We're going to make the boat go in reverse. We're going to take advantage of the market falling. Okay, and then the last equity sail is what we call our factor strategy. There's a lot of work that's been done on factors, and we're looking at various factors trying to determine which ones might be probative of future return. And so we like to look at factors. And again, if we're bullish on the long end of the market, we'll have our factor sail up. If we're bearish on the long end of the market, we'll have our factor sail down. So that's how we build the boat, is by, if we're bullish on the short, mid, and the long, we'll have all of our sails up. If not, we can be in a defensive mode. And of course, we've got our fixed income to make sure that the boat doesn't fall over. When you think about building a portfolio, that conservative portfolio that we talked about, that strategic overlay, a conservative portfolio has a lot bigger boat and a little sail. The moderate conservative sailboat has a little smaller boat than the conservative and a little bigger sail. The moderate sailboat, right, continues in that theme. It has a little smaller boat and bigger sail. And of course, when we get over to the aggressive portfolio, it has the smallest amount of boat, fixed income, the safety, and the most amount of sails. Okay, so that's how we maintain a suitability for you by having 5 portfolios: conservative, moderate, moderate aggressive, and aggressive. And we continually rebuild the boat over time. So at one point in time, the moderate boat might be 70% fixed income and 30% equity sales, or it might be 70-30 or 60-40. So the size of the boat also is continuously rebuilt depending on the seas that we're sailing in. Okay. Now we have to turn to security selection, right? So now we know if we're bullish or bearish, we know what sails we want to up or down, but now we need to select what's going to go into those sails. And of course, we don't just want to measure once and cut, we want to measure 3 times and cut. So we're going to use 3 or more ranking methodologies. So let me illustrate. So the first ranking methodology is represented by squares. Okay, and this would have been A, B, C, D, and E. And so we would have seen under this ranking methodology that A and B were above water, okay, and they would have made it into the portfolio. Now, when we look at the circles, which is a uniquely different selection process, the order was different. It was D, A, E, C, and B. So D and A would have been selected because they were above water. If we look at the third ranking methodology, the triangles, so again, a uniquely different selection process, okay, it would have come up A, C, B, D, and E. But here we would have seen A and C were above water. Now, if we would have only used method number 1, B would have made it into the portfolio as well because it was in second place. But when we used the other 2 ranking methods, we see that B was underwater on both the second and third ranking methodology. So we lost our conviction, right? We weren't as convicted. But when we use all 3 ranking methodologies collectively, again, looking at the preponderance of the evidence, we see that A was in the top 1 or 2 spots under 3 uniquely different ranking methodologies. And so that gives us much more comfort that we might be making the right decision by putting A into the portfolio, right? So with that evidence, we would then make that security selection and put it in the appropriate equity sale. So that's how we build the portfolio, by being bullish or bearish, knowing what size of boat we're going to build, and then knowing which security should go into which sale at which time, okay? So step 4 is just to repeat steps 2 and 3. So we're always re-monitoring the market. We monitor it daily and weekly and monthly and quarterly and on and on. So we're always looking to see what the signals are saying, smoothing that data, coming up with our bull or bear determination to know if we should have our sales up or down. Then once we know if we're bullish or bearish, we build the sailboat by knowing how much fixed income to put into the boat, how many sails to have in the boat, and which ones should be up and which ones should be down. And so by repeating that process and having this nice institutional process drive our portfolio construction process, it leads to very consistent results, and it leads to what we believe will be smooth sailing. With that, I want to thank you for listening to me today. We appreciate you very much. We hope you enjoyed this portfolio. Of course, if you have any questions, just reach out and contact us, and we'd be happy to go deeper into how we build the sailboat. So again, my name is Joe Mass, and I thank you so much. Have a great day. Bye-bye.